Good morning, everybody. So this time last year, I stood here and said that it was a really good time to be investing in global equities. And at that time, that was a difficult message for people to digest, because remember that we'd just come out of 2022, essentially the worst year for financial markets that we'd had for, well, basically for 50 years. But then if we fast forward to today, actually, last year was a pretty good year for equity markets. So what am I going to say today? Well, today I'm actually going to give a very similar message, that I think that this is a good time to be investing in global equities. And there's really three reasons for that. So the first reason is that interest rates are peaking. And when interest rates peak, that's generally a pretty good time to buy global equities. The second thing is that leadership in financial markets is changing. That's a big opportunity. And the final thing is that as the world changes, there are very powerful new secular trends that are starting to emerge. And that can be very, very rewarding for investors. Okay, so let me start by just explaining why I think you should listen to me. So who am I? Which company am I representing? So I work for Capital Group. We're a specialist fund management company. All we do is manage money for our clients. And we've been doing that since 1931. Today, we're managing almost $2.5 trillion of our clients' assets. Most of that's in equities. That makes us the world's largest active equity manager. But we're also managing $500 billion in fixed income. So we're one of the world's larger fixed income managers as well. Now, big is not always beautiful. However, this scale does mean that we can build a pretty large investment team, 500 or so investment professionals, and they're a very experienced group, on average around about 25 to 30 years of experience in our portfolio managers. So that's the credentials of Capital Group. So let's now move on and talk about investing. And I want to start with the outlook for the macroeconomy. And I think the main message that I have here is that it's very important to remember that over the last couple of years, the world has really changed. It's a very different world from the one that we've been used to over the last 10 or 20 years. Obviously, inflation is back. Hopefully, inflation is going to keep coming down from current levels, but we're definitely going to be seeing inflation above 2% for the next few years. Interest rates are a lot higher as well. Again, they're probably peaking right now, but they're going to stay high for a while. Economic growth is proving harder to find, and that means that if you want to invest in growing businesses, you need to look harder for them. Globalization is changing shape, and I'm going to come back to that one in just a minute. And then finally, leadership of financial markets is also changing. For most of the last decade or so, there was only one game in town. That was digital disruption. Looking ahead, we think that leadership of financial markets is going to be much, much broader. So we're investing in a different world. Very important to remember that. So what should an investment look like in this world? Well, I think the first thing to remember is that interest rates are likely peaking almost as we speak. So for the last year, investing in cash has been a pretty good strategy. Think T-bill and chill. That was a good strategy. However, as central banks peak, we gradually see interest rates come down. And this data is just looking at what happens to interest rates after central banks finish tightening. And it's looking at the average behavior of interest rates over the last 30 years. So essentially, over the next couple of years, interest rates are going to likely to come down by a couple of percent. Okay, so much for cash. What about other investments? Well, what we're looking at here, is, again, looking back over the last 30 years or so, is when central banks peak, what typically happens to the returns on cash, fixed income, and equities. And so, firstly, we've got cash at the bottom of the chart there, and obviously cash continues to deliver positive returns, although those returns come down a little bit. Bonds do better than cash. So remember, now is a good time to be buying bonds, locking in higher interest rates, and then potentially enjoying the value of your bonds going up a little bit as interest rates come down. But you look at what's at the top of the chart there. It's equities. So in the past, when central banks peak, this has been a good time to be investing in equities. And this is essentially because when central banks peak, we've got moderate growth, moderate inflation, and that's what we like to call the Goldilocks environment. So pretty good environment for equities. So quite a strong message that historically, at least, this is a good time to be building an equity portfolio. And remember that at the moment, a lot of investors have not started to build their global equity portfolio. What we're looking at on this chart is actually the level of cash holdings around the world. And at the moment, we're actually looking at the highest level of cash holdings ever. So investors are sitting on cash, embracing that strategy of T-bill and chill. But you can also see that historically, when investors have held so much cash, this has often been the signal for equity markets to do really rather well. And we expect that this will probably be the same this time as round. So really important to be thinking about how to get some of this cash invested. Now, you might also say, well, hang on, haven't I missed the run in equity markets? Equity markets were up 20% last year, I've missed it. And the answer to that question is no, but you need to look inside equity market returns to understand that. Equity markets were up 20% or so last year, but most of the investment gain actually came from just 7 companies, 7 American companies. They go by different names. It's the Fanamats. I think of them as the Magnificent Seven. So these stocks did really, really well, up almost 70% or so through the year. And they drove most of the investment gain. But other stocks generally did much less well. And in fact, if you look at the valuations of companies, the Magnificent Seven, the valuations do look quite high. But the rest of the market, valuations look quite reasonable. So I'd argue that you, in fact, have not missed the run in equity markets as long as you build a very, very careful equity portfolio. So what should that equity portfolio look like? What will lead in equity markets? And I'm going to make the case that what leads in equity markets moving forwards is going to be different from what led equity markets in the past. And actually, there's nothing new there. Every time we see a big correction in equity markets, we always see leadership of markets change. We saw it when the dot-com bubble burst. We saw it when the global financial crisis hit us really hard. And I think we're going to see it in this post-pandemic world as well. Obviously, we didn't see it last year. Tech continued to lead the way. But moving forward, I think we can expect to see broader leadership across equity markets. And one other thing that I really want to emphasize is this idea of investing in multinational companies. It can be very unnerving to pick equity investments when the world is going through so much dramatic change. But a formula that has worked again and again is the concept of global champions. So multinational companies with diverse product lines, doing business in multiple countries with strong balance sheets, strong management teams. And these have again and again proven to be a really great way to invest in the long term. And I've shown just a couple of examples from holdings from one of our flagship equity funds. And the way this chart works is the small bubble shows the size of the company when we first bought it. Obviously, we're showing the year when we first bought the company there as well. The big bubble shows the size of the company today, and then we've shown how much the company has grown over time. So Microsoft first bought it in 1997. The stock's gone up 18 times. Novo Nordisk, it's a pharmaceutical company. 2003, since then, it's gone up almost 40 times. And Tesla, we bought that in 2014. It's gone up 31 times. So this idea of focusing on global champions to help navigate a period which really looks quite uncertain. Okay, so at this point then, I'm making the case that with interest rates peaking, good time to be buying global equities, and then I'm also saying be ready for the fact that leadership will change and global champions will be a good way to invest. But what I'd love to talk about now is some very powerful secular trends which we think are starting to emerge strongly and which are going to drive really strong returns over the next 5 or 10 years. And I'll just start with the one in the bottom right-hand corner. Actually, this is a story we all know. Digital disruption. Companies using the internet and technology to disrupt their industries and actually sometimes to create new industries as well. It's done really well for the last decade. Actually, it looks like it will continue to do well. So the emergence of generative AI and ChatGPT earlier last year has been the catalyst to give a real new lease of life to digital disruption. So don't forget about digital disruption. But do also think about innovation in healthcare, changing shape of globalization, and also the green energy transition. And let me unwrap those in a little bit more detail. And I'm going to start with healthcare. So I'm going to make this bold statement that we are going through a golden era of innovation in the healthcare industry. Healthcare is always an innovative industry, but today it really is a golden era of innovation. Many examples I could give, but the one I've called out here is actually a pharmaceutical example, and in particular, it's the new range of obesity drugs that we've seen created over the last couple of years. Obesity is a real problem for the world. So in the US, it's estimated now that about half of all adults are obese, and looking around the world, thinking by the end of this decade, we'll be well through 1 billion people struggling with obesity. And this is a problem, because obesity brings all sorts of other health ailments, so cardiovascular disease, kidney disease, liver issues. The latest research actually shows that the inflammation associated with obesity actually causes critical diseases like cancer as well. So today, the world is spending about 2% of GDP trying to deal with obesity. So any company that can produce a drug that helps to deal with obesity is actually set to do really well. And today there are two, Eli Lilly and Novo Nordisk. They've produced these amazing new drugs. They're called GLP-1s. And they're proven to reduce obesity. One clinical trial says that on average, when somebody takes these drugs, they lose about 20% of their weight. And so clearly these things work, and they have the potential to be the biggest pharmaceutical drugs of all time, $100 billion drugs. So very powerful secular trend. So let's talk a little bit about the changing shape of globalization. I think we're all aware that we live in a world where geopolitical tensions are starting to rise. We're all living with this strategic rivalry between the US and China, and now Russia has entered the fray again. And I think we'd probably all agree that it's deeply unnerving, it's very worrying for us. A lot of people say to me, well, with these new tensions, we're going to see trade barriers coming up, and actually globalization is going to come to an end. I disagree. I don't think globalization is going to come to an end, but it is going to change shape. And in particular, we're going to see a restructuring of global supply chains. Semiconductor manufacturing would be a great example. Semiconductors are everywhere. They're essential for every economy in the world, but most leading-edge semiconductors today are made in Taiwan or China. And so every major region is now demanding that semiconductors get made actually in their home region. Big investment opportunity. In a world where trade barriers are constantly coming up and down and moving, having a great shipping company like DSV that can help provide really flexible, agile shipping solutions, that's pretty interesting. What about onshoring, nearshoring, friendshoring, China plus one shoring? Well, one consistent factor in that is that they all require more commodities out of the ground and then turned into infrastructure. And Caterpillar is really well positioned to make the machines that will help with that. So changing shape of globalization, big investment opportunity. And then the final one I'll call out is the green energy transition. We all know that the world is trying to get to grips with net zero carbon by 2050. Not really sure if we're going to get there, but I am very confident that many companies are going to be very successful helping the world to try and go through this transition. And lots of examples I could call out here. One that we all love to talk about would be electric vehicles. Think of Tesla. EVs require batteries. Tesla, again, a big manufacturer. Batteries require lithium, and there's not enough lithium being produced in the world, so that's an investment opportunity. Obviously, renewable power as well. The world needs a lot more electrical grid. Schneider Electric makes all the components that go into electrical grid. And then the final one I'd call out would be hydrogen. We love to talk about electrical vehicles, but for some transport applications, hydrogen is actually a better solution. So a company like Linde that is a leading producer of blue hydrogen and green hydrogen, a very exciting investment opportunity. And the final thing I want to throw in is not so much a secular trend, but a reminder that when investing in equities, it is critically important to have a long-term perspective. And I always find this chart fascinating. Essentially, it's looking at the value of $10,000 invested in the global equity market 50 years ago, so 1973. And it's seeing how the value of that $10,000 has grown over time. And essentially today, $10,000 50 years ago has grown to almost $600,000. And that alone is a really spectacular outcome, and clearly confirmation that this chart basically moves up and to the right all the time. And if you can have a long-term perspective, it doesn't really matter too much when you invest. The key is to get invested. Now, of course, you can also see that there are some bumps along the road here. And you can see the bursting of the dot-com bubble, the global financial crisis. It takes a while to recover from those. Actually, 2022, we saw a very sharp decline in equity markets, but actually, for the long-term investor who was just prepared to stay with equity markets through that period, actually, they've made back their money already. So just a reminder that when you're investing in equity markets, very important to have that long-term perspective. So let me bring things to a close. So actually, the first thing I'd like to highlight, if you're interested in learning any more about the things I've spoken about today, do please go to the Capital Group stand. I have a number of colleagues there who will be keen to talk to you about our new perspective strategy, one of our flagship global equity strategies that embraces a lot of what I've spoken about today. But let me again just kind of bring things to a close. So what would I like you to take away? So the first point is a good time to be building an equity portfolio. Central banks are close to peaking. They might even have peaked already. And historically, this has been a very good time to build positions in equity portfolios. And if we can get into that Goldilocks environment of moderate growth, moderate inflation, this will be good for equities. Secondly, remember that what led markets for the last 10, 15 years is not going to be the only thing that leads markets for the next 5 or 10 years. Market leadership is going to broaden, and always remember that global champions are the best positioned to really benefit from this environment. And then the final thing is this idea of secular trends as being a very powerful way to invest. If you can invest in companies that benefit from the most powerful secular trends that literally define the investment environment, sometimes they even define the world that we're living in, then this can be a very rewarding way to invest. And I'd highlight, of course, changing shape of globalization, innovation in healthcare, the green energy transition, but also remember that digital disruption is not dead and has a new wave of growth coming from what we're seeing in artificial intelligence. So I'm going to close there, but I wish everyone a happy new year and very good luck with your investing for this year.